All right, let's talk about what happens when politics slams headfirst into the stock market. Today, we're going to break down the anatomy of a true market meltdown, the wild events of January 20th, 2026. This was a day when a single announcement sent massive shockwaves through the entire financial world. And the day kicked off with this, just an absolutely raw, unfiltered take from Hunter AGI over at PhilStockWorld. They wrote, "You get what you deserve, motherfuckers. A critical chunk of the population decided democracy was optional homework." I mean, what a way to start the day, right? But it perfectly captures that visceral anger and frustration that really define the mood. But to really get what happened, we need to rewind a little bit. Because before all the chaos, the market was in this really weird place. It was deceptively calm, sitting at record highs, but it was just riddled with these underlying tensions. So let's look at that setup. I mean, on the surface, everything looked incredible, right? The S&P 500 was knocking on the door of 7,000. The Dow was getting super close to that huge psychological milestone of 50,000. These weren't just records. This was a market that felt completely supercharged, mostly by the AI boom and some of those easing trade tensions from back in 2025. But if you peeled back just one layer, you'd see Wall Street was completely split. It was this huge tug of war. You had the bulls on one side, dreaming of S&P 8,000, all powered by AI and deregulation. But on the other side, the cautious crowd, the bears, they were pointing to some really serious warning signs. Valuations were sky high, the labor market was softening, and maybe worst of all, a near zero equity risk premium. That's the extra bit of return you're supposed to get for taking the risk of owning stocks. And it had basically vanished. The whole market was stretched dangerously tight. And that tension, that stretched out rubber band, is exactly why the whole thing snapped. A geopolitical bombshell dropped over a quiet holiday weekend just shattered everything. So here's how it all went down. U.S. markets are closed for the holiday. Nice and quiet, right? Nope. Over the weekend, President Trump drops this threat: new tariffs on 8 NATO countries unless they backed the U.S. acquisition of Greenland. So when traders woke up Tuesday morning, the reaction was immediate and it was brutal. Futures just went into a nosedive. And this is so important to understand. This wasn't a company missing its earnings. This was a policy shock. It's one of those events that just throws out the entire rulebook. All the old spreadsheets, all the forecasts. Suddenly, they're all irrelevant. The game was being rewritten in real time. Okay, so let's get into the reaction. As that opening bell got closer, all that pre-market anxiety it boiled over into a full-on panic, and the damage was everywhere. Just look at the fear before the opening bell even rang. The tech-heavy NASDAQ 100, leading the charge downhill, down almost 2%. This set such a bearish, ugly tone for the day. Everybody knew it was going to be a bloodbath. And if you need proof, here it is. The VEX, Wall Street's so-called fear gauge, just exploded, a 27% spike. Anything over 20 signals some really serious anxiety. This wasn't just selling, my friends. This was a stampede for the exits. And what happens when traders panic? It's a classic risk-off move, a flight to safety. They start dumping everything, stocks, even government bonds, and they just pile into the traditional safe havens. And the number one destination? Precious metals. And the result of that? A massive surge in gold. It jumped over $170 to a new all-time high. People were just desperate for anything that felt stable when the market felt completely unmoored. So, while most of the market is running around with its hair on fire, some communities were taking a totally different approach. Let's dive into the PhilStockWorld playbook and see how they were navigating this chaos in real time. Their AGI roundtable, which is this really fascinating mix of human and AI analysis, laid out a game plan right away. And their key insight? It was simple but so powerful. This is about policy, not a broken economy. So the advice was basically, don't panic. Look for opportunities that the panic is creating. And you gotta love this part. They told everyone to watch for a taco moment. That stands for Trump always chickens out. The whole idea was that this entire crisis, created by a single statement, could be erased by another one just as quickly. And look, this wasn't just talk. While everyone else was bleeding red, they were pointing to a trade they had put on days before based on fundamentals. Their bullish call on natural gas absolutely paid off, banking over $4,000 per contract. It's a perfect example of their whole strategy. Ignore the political noise, focus on the fundamentals, even in the middle of a meltdown. Okay, so let's fast forward to the end of the day and really tally up the damage. Because despite some smart plays out there, the market as a whole took a serious, serious beating. And here it is, the final report card. By the closing bell, it was officially the worst day of 2026. The Dow fell 1.8%, the S&P 2.1%, and the tech-heavy Nasdaq, well, it took the biggest hit, down 2.4%. Just brutal. But the real damage went way beyond just the percentages. For traders, it was the technical picture that looked so ugly. Both the S&P and the Nasdaq crashed right through their 50-day moving averages. You can think of that like a key support level for the market's health. And poofs, in just one single session, every gain made this year was just gone. The market was left on really fragile footing. And that really brings us to the big final question, doesn't it? The events of that day were a stark reminder that markets don't operate in a vacuum. So when a single political statement can invalidate months and months of analysis overnight, it forces us to ask a really fundamental question. In a world of these policy shocks, how do we even begin to calculate the true value of risk?